Welcome to the Byte-Size Brief. Today, we are putting Bloom Energy, BE, that's BE, completely under the microscope. Let's get into it. You know, imagine trying to power a small city,
Okay.
but you only have like 55 days to build the whole power plant from scratch.
Which is basically impossible, right?
Right. And if you miss that deadline, you are losing literally billions of dollars to your competitors. That is the exact nightmare the world's biggest tech giants are facing today, and it is precisely why we are doing this deep dive.
It really is a fascinating time to look at this company because the entire global energy landscape is just shifting beneath our feet right now, and Bloom Energy, BE, has kind of positioned itself right at the epicenter of that quake.
Shifting feels like an understatement when you look at the chart. I mean, the mission for today's deep dive is to figure out if this company's astronomical market movement is actually justified by reality.
Yeah.
We are looking at a stock that has absolutely skyrocketed over 887% year to date.
It's wild.
They're sitting at a massive $56 billion market cap right now. So to figure this out, we've pulled together a massive stack of sources. We've got everything from their Q4 2025 earnings calls and SEC filings to the recent hyperscaler deal announcements like with Oracle and AEP.
We also have some deep techno-economic analyses to unpack today, too.
Exactly. Our ultimate goal here is to determine if this massive valuation is backed by a true fundamental paradigm shift in how we generate energy, or if it's just, you know, a product of the current AI-driven market hype.
It is the classic investment question, right?
Yeah.
How do you discern a structural permanent change from a speculative bubble?
Right.
And the data we have is incredibly revealing if you know where to look.
And to you, listening right now, have you ever actually wondered how these massive AI data centers get their power?
Yeah.
We constantly hear about AI changing the world, but the underlying physical reality is that these data centers require an almost incomprehensible amount of electricity.
Yeah, gigawatts of it.
And they need it right when the traditional electrical grid is visibly stretched to its absolute breaking point. It's a logistical nightmare on a global scale.
It really is the defining bottleneck of 2026. I mean, you cannot train or run next-generation AI models without hyperscale data centers.
Right.
And you cannot turn on a hyperscale data center without hundreds of megawatts of reliable, continuous power. The physical infrastructure simply isn't there.
Which naturally brings us to why Bloom Energy, BE, is surging so aggressively right now.
Yeah.
The fundamental problem of 2026 is that AI hyperscalers need power today, not tomorrow, not, in a few years, today. And the traditional utility grid simply cannot deliver it fast enough.
That is the core structural tailwind driving this entire narrative. It's all about one concept, and that's time to power.
Time to power, yeah.
Exactly. If you are a tech giant building a massive facility, connecting to a traditional grid requires high-voltage transmission lines. That means environmental reviews, securing right-of-ways, eminent domain battles, and laying miles and miles of physical copper.
It's a massive headache.
It is, and even alternative on-site solutions, like building a massive gas turbine power plant, take incredible amounts of time. Permitting and physical construction of a traditional plant can take anywhere from 3 to 5 years.
3 to 5 years. I mean, that is an absolute eternity in the tech world. If you wait 5 years to turn on your AI factory, your competitors have already made your technology completely obsolete.
Precisely. Bloom Energy, BE, on the other hand, delivers solid oxide fuel cell power in months.
Wow.
They literally drop modular steel boxes onto your site. To give you a concrete example from our sources, they recently delivered a hyperscale AI factory order in 55 days.
Just 55 days.
Yeah, and that was against a 90-day commitment.
55 days. That is practically overnight in the world of heavy utility infrastructure. You just pour some concrete, drop the boxes, connect the fuel, and turn it on.
Exactly.
And that sheer speed is translating directly into massive contracts. Just look at the Oracle validation we saw in April 2026. They expanded their existing deal from 1.2 gigawatts to 2.8 gigawatts.
Which is a huge jump.
It is. That one single deal expansion represents a staggering $4.0 to $4.5 billion incremental revenue opportunity.
It really illustrates the desperation and the sheer scale of capital deployment happening in the broader AI sector right now. When you look at companies like Meta or Amazon, they're fundamentally struggling with energy constraints across all of their new builds. I mean, the amount of capital they are deploying, sometimes $2 billion a day in a concentrated area, is entirely bottlenecked by whether or not they can actually plug the buildings in. The entire tech sector is scrambling because the grid just wasn't designed for this kind of localized massive load.
Right, but what does all that actually mean for Bloom Energy BE investors?
Fair point. Let's bring it back to the specific technological moat that Bloom Energy has built. Like, why are they winning these specific contracts over legacy technology?
Yeah, why them specifically?
There are two crucial data points here that investors really need to understand. First, their energy servers natively output 800-volt DC power.
Okay, let's unpack this because DC versus AC power can get really confusing. So grid power is AC alternating current. It flows back and forth. But computer server racks only understand DC power direct current, which is a straight line.
Right.
If we use a language metaphor, it's like the grid speaks Spanish, but the servers only speak English. Usually you need a massive, expensive translator in the middle, transformers and rectifiers. But that translation process is highly inefficient, right? It wastes about 15% of the energy, and that wasted energy turns into pure heat.
And heat is the absolute enemy of a data center. So not only are you losing 15% of the power you just paid for, but now you have to spend even more power running massive air conditioning units just to cool down the heat generated by your translator.
Exactly. So by natively outputting 800-volt DC power right out of the box, Bloom Energy, AB, essentially speaks the server's language perfectly. It natively skips that 10 to 15% conversion loss completely.
That efficiency gain is massive. When you are dealing with gigawatt-scale power consumption, saving 15% translates to millions of dollars in operational savings and drastically lowers the cooling requirements.
That's huge.
But the second technological advantage is arguably even more critical for AI specifically, and that's how the system handles rapid load swings.
Because AI processing isn't just a steady, predictable hum, right? It spikes wildly depending on user prompts and processing tasks.
Exactly. AI inference workloads create wild, unpredictable swings in power demand. Now, Bloom Energy, BE, can handle a 120% per minute ramp rate.
Okay.
Let's look at conventional combustion turbines, which are the main alternative for on-site power. They physically struggle with this. A gas turbine is essentially a massive spinning piece of metal machinery, kind of like a jet engine.
Right. It relies on physical momentum.
Yes. When an AI load suddenly demands a huge spike in power, it acts almost like a physical brake on that spinning turbine shaft. It causes extreme physical torsional stress.
Oh, wow.
To prevent the turbines from literally tearing themselves apart from the torque, operators have to install massive battery backups just to buffer the load.
Like shock absorbers.
Exactly. For example, Tesla's Memphis data center famously required large-scale megapack battery storage just to manage these stresses. Bloom Energy, BU, manages these massive AI load swings without needing a single battery.
Let me make sure I understand the mechanism here. Because there are no heavy physical metal fan blades that need time to spin up to speed, a fuel cell just, increases the chemical reaction instantly. It's basically the difference between waiting for a massive freight train to accelerate versus just turning up a dimmer switch on a light bulb.
That is a perfect analogy. Because it's a solid-state electrochemical reaction, they just feed more fuel into the cell, and the power output scales up instantly without any moving parts tearing themselves apart. It is a completely different paradigm of power generation.
Okay, so compared to last quarter, what actually moved the needle here?
Let's subjectively break down the Q4 2025 numbers. They achieved record top-line revenue of $777.7 million.
Wow.
Yeah, that is up 35.9% year over year. To put that $777 million into perspective, they didn't just beat Wall Street's expectations, they shattered them by nearly 20%. For a company selling massive physical hardware, literally shipping heavy steel boxes across the country, moving that much inventory is a massive logistical triumph.
It is a phenomenal execution metric. And on the bottom line, their adjusted earnings per share EPS came in at $0.45.
All right.
Which was a massive 50.4% beat against expectations.
Incredible.
And looking ahead, their full year 2026 revenue guidance is accelerating, projecting somewhere between $3.1 billion and $3.3 billion.
And what gets me really excited as an investor is the service segment turnaround.
Yeah.
They have a $6 billion product backlog, sure, but a massive $14 billion service backlog. Every product they sell attaches to a long-term service contract. That is recurring revenue.
That requires some historical context, though. For years, the service segment was actually a significant drag on their profitability. It was a major point of concern for analysts because, frankly, replacing degraded fuel cells is expensive.
However, quarter over quarter, we are seeing a durable shift. The service segment has maintained profitability for 8 straight quarters now, hitting an impressive 20% gross margin in Q4.
How do they turn that liability into a profit engine?
By leveraging AI and digital twins. They create a highly detailed virtual replica, a digital twin of every single physical fuel cell they have deployed in the field.
Yeah.
This virtual model simulates exactly how the physical cell is performing, allowing them to predict exactly when a component might fail before it actually does. This drastically lowers their preventative maintenance costs and extends the overall lifespan of the cells.
Wait, are they literally building a virtual SimCity version of every fuel cell to see when it might break?
Pretty much.
That is incredibly smart. But it wasn't all perfect in the Q4 report, right? We have to look at the whole picture here.
Right, let's pump the brakes and look at the red flags, because there are always red flags. Despite that massive revenue beat, their Q4 gross margin actually dropped. It fell to 31.9% from 39.3% in the prior year. Management attributed this to project mix variability and some supply chain cost pressures. Additionally, inventory closed slightly higher than planned, sitting at $643 million.
Hold on, how does that margin drop actually affect Bloom Energy, BE's stock price, for regular investors like me?
Yeah.
Because honestly, it sounds bad to have your profit margins shrink exactly when your revenue is exploding.
It is a very valid concern, and normally a margin compression of that size would trigger a massive stock sell-off.
Right.
However, investors looked past it this quarter because of the ultimate corporate safety net, cash flow. Bloom Energy achieved positive free cash flow of $33 million for the full year 2025.
Okay, that's reassuring.
In the highly capital-intensive world of clean tech hardware, generating positive free cash flow is the holy grail. It proves the business model can actually sustain itself without constantly begging the market for more money. Furthermore, management explicitly stated they do not expect to issue equity to fund their standard growth.
Meaning no stock dilution for existing shareholders just to keep the lights on and the factories running. That is a massive sigh of relief.
Exactly. They also secured $2.2 billion in 0% convertible notes.
Let's explain convertible notes for a second for the listeners. That is basically giving a company a loan, but instead of demanding cash interest payments back, the lender gets the option to convert that loan into shares of stock later on. The fact that the interest rate is 0% means the lenders are so incredibly confident that Bloom Energy, BE's stock price, is going to rise, they're willing to forego standard interest payments entirely just for the right to own the stock in the future.
That is a brilliant way to phrase it. It shows immense institutional confidence. Combined with their existing cash, they are sitting on a $2.5 billion cash pile.
Wow.
This incredibly strong balance sheet entirely secures their asset-light push to reach 2 gigawatts of manufacturing capacity. The market viewed the margin drop as a temporary project mix speed bump, heavily outweighed by their massive cash runway and their inflection into true profitability.
So we are really seeing a fundamental transition here. Bloom Energy, BE, is evolving from a highly speculative clean tech story into a highly valued, reliable infrastructure staple.
Yes.
And having that cash pile is the perfect narrative transition to discuss the stock's current valuation. Because when a stock runs up nearly 900% in a few months, there is a massive tug-of-war happening between buyers and sellers.
There is an incredible amount of market noise right now. High volatility is absolutely guaranteed.
Let's talk about a specific retail panic we saw in the sources, because this perfectly highlights the noise. Recently, there was a brutal 15.5% single-day stock drop triggered purely by Reddit rumors.
Yes. The Reddit rumors.
The internet was buzzing that a massive planned Oracle and OpenAI data center project in Abilene, Texas was either canceled or delayed. I saw that 15% drop and panicked. I mean, when you hear Oracle canceled, logic said get out. How is retail supposed to know what was actually going on? The market treated it like a direct torpedo to Bloom Energy, BE.
Yeah, the infamous Stargate project rumor. If we calmly look at the actual source data, we can debunk this noise completely.
Okay, let's hear it.
The Abilene project in Texas was tied to traditional gas turbines connected to the ERCOT grid. It had absolutely nothing to do with Bloom Energy, BE. Bloom's actual hyperscale deployment for that specific client is happening in an entirely different location in Wyoming, which is known internally as Project Jade.
Wow, so the market severely overreacted to a scary headline without even checking the underlying technical specifications of the canceled site.
Pretty much, yeah.
It just goes to show how jittery investors are right now. They hear Oracle and canceled and just instinctively hit the sell button. But even after debunking that specific rumor, we still have to do a harsh reality check on the valuation itself.
We do. We have to lay out the bear case here because the multiples are staggering.
They really are.
With the stock trading around $209, the forward price-to-earnings ratio is a steep 119x. The price-to-sales ratio is 12.4x, which is a 218% premium over their own historical average. And some quantitative models, like those at Investing Pro, suggest the stock is actually 49.9% overvalued, calculating a grounded fair value of only around $111 per share. But on the exact flip side, Wall Street analysts at JP Morgan just raised their target to $231, citing the Oracle deal as a massive, permanent stamp of approval.
It's a classic battle. You have historical fundamental metrics screaming overvalued on one side and unprecedented future growth projections screaming buy on the other.
Right.
But beyond just the multiples, there are also structural financial risks embedded in the company we need to be honest about.
Yes, specifically regarding dilution and the capital structure of their deals. While management said they won't issue equity to fund standard growth, we still have to look at the Oracle warrant exercise.
Right, and warrants are basically like a VIP coupon. It gives a partner the right to buy shares of stock at a locked-in price, regardless of how high the actual market price goes.
Correct. As part of their massive expansion deal, Oracle exercised their warrants for approximately 3.5 million shares at $113.28 per share.
Which injects about $396 million in pure capital straight into Bloom Energy BE's bank account.
True, it's a huge cash injection, but because they are issuing new shares to Oracle, it causes immediate dilution to existing shareholders. Your slice of the pie just got a tiny bit smaller.
Right.
But the larger financial risk actually lies in the cost structure of the technology itself. A deep techno-economic analysis from our sources shows that Bloom Energy, BE's capex, their capital expenditure, meaning the sheer upfront cost to buy the physical hardware, makes up a massive 80% of their total as spent costs.
Wait, 80%?
Yeah.
So the actual fuel cells are incredibly expensive to buy upfront, even if they are highly efficient to run later.
Exactly. But because that upfront purchase cost is so astronomically high, the company's economics are highly sensitive to interest rates compared to traditional gas turbines or reciprocating engines, which are, the standard benchmarks in the power industry.
That makes sense.
If a customer is borrowing hundreds of millions of dollars to buy a Bloom Energy BE system, high interest rates severely impact the financial math. It makes the initial hurdle much harder to clear.
Okay, I have to push back on this capex concern, though. Sure, the upfront cost of the box is huge, but we just talked about how waiting for the grid takes 4 years.
Right.
If you factor in the opportunity cost of waiting 4 years for a grid connection, doesn't Bloom Energy, BE, actually save these data centers money from day one? I mean, if I'm building a $2 billion AI data center, every single month that building sits empty, waiting for the utility company to lay copper wire, is costing me an absolute fortune in lost computing revenue.
That is the exact counter-argument, and honestly, the data entirely supports your intuition.
Right.
The techno-economic analysis models this exact scenario. It uses a metric called LCOE, the levelized cost of electricity.
LCOE is just a fancy way of saying the true cost of a single unit of power over the machine's entire lifespan, right? It includes the cost to buy it, run it, and fix it.
Exactly right. And normally, Bloom's high upfront cost hurts their LCOE. But when you factor in the data center lease revenues, the actual money the hyperscalers make by getting the data center online and renting out server space years earlier, Bloom Energy, BE's LCOE, massively undercuts the benchmark gas turbines in almost every single market.
This completely flips the math on its head. We spent decades in the energy sector arguing about the cost per kilowatt. But AI hyperscalers don't care about the electricity bill. They care about the calendar.
Exactly.
If Bloom gets a multi-billion-dollar data center online 3 years faster than the grid, the fuel cells essentially pay for themselves before the traditional grid company even finishes the permitting paperwork.
That is the aha moment right there. The opportunity cost of waiting for the grid completely dwarfs the higher upfront capital expenditure of the fuel cells. It fundamentally changes the entire industry paradigm from a simple cost per kilowatt equation to a speed to revenue equation.
Which is exactly why the hyperscalers are throwing billions of dollars at them without blinking. Zooming out from all the metrics, it is vividly clear that Bloom Energy, BE, has firmly positioned itself as the premier bring-your-own-power standard for the entire AI revolution.
Without a doubt.
But having a $20 billion backlog is one thing. Flawlessly executing on delivering that hardware over the next 12 to 24 months is going to be incredibly critical to maintaining this valuation.
Execution is everything at this stage. They have the contracts, now they have to build the boxes. But I want to leave you with a final, forward-looking question to ponder, something that builds on all of this structural analysis.
Let's hear it.
Right now, Bloom Energy, BE, relies heavily on natural gas to run these fuel cells. Now, they do have highly efficient solid oxide electrolyzers designed for green hydrogen, which is amazing, but the global green hydrogen economy is still very much in its infancy. It is not ready for scale.
So they are tied to natural gas for the foreseeable future.
Yes. So here is the question. If natural gas prices experience a massive, sustained spike, or if the broader electrical grid finally manages to catch up to demand and streamline permitting in the 2030s, will Bloom Energy, BE's massive speed-to-market advantage evaporate? Are they establishing themselves as a permanent, decentralized utility replacement, or are they just an incredibly lucrative, temporary bridge technology serving the immediate panic of the 2026 AI boom?
Man, that is the multi-billion-dollar question that will define this stock for the next decade. All right, listeners, what's your take on the future of Bloom Energy? BE, are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.